Hi, everyone. 2023 is moving right along. And in terms of the markets, it's been an interesting start to the year. One question I'm getting from investors at the moment is, should I take risk off the table or should I stay the course? I'm Valerie Leonard, founder of EverThrive Financial Group, and I'm going to interpret some of the market news for you and give you some food for thought on how you might approach the remainder of 2023 as an investor, specifically in light of this question. My goal is to give you the unvarnished truth on what I see happening so that you can make informed decisions about what's best for you. Now, let's start with some general rules of thumb that I'm trying to communicate to all investors when they think about their investment strategy for the next 6 to 10 months. First of all, regardless of how you feel at this very moment regarding the economy, the markets, or even politics, I want to encourage you to have an open mind about the potential for better than expected outcomes, but also keep an open mind about the potential for worse than expected outcomes. Okay, so here's the thing. The average bear market historically lasts about 446 days, according to Charles Schwab, with the average return in the 12 months following a bear market bottom totaling 46%. So last year was a bad year, and while we can't say with certainty whether the market bottom is in, we do know that we can likely expect some big returns at some point going forward. But on the flip side of that, we know that there are still a lot of risks out there, especially when we examine the shape of the U.S. consumer. And we're going to talk about that more here in just a minute. But I'm not fully convinced that we're out of the woods just yet. So either way, here at EverThrive, we are prepared for all scenarios, and we're going to keep our clients informed and do our best to help protect their investments. Which brings me to my second point, and that is to stay flexible. So in other words, I believe that your investment manager needs to be monitoring conditions day by day and be prepared to make changes when circumstances change. So whatever lies ahead of us, right now, we're trying to keep our finger on the pulse, and this is where risk management really comes in. Managing your risk is a big theme for this year, and we know that the economy is still trying to find its footing. That makes it even more important to be prepared to manage downside risk. And then fourth, when you have cash, dollar cost averaging is a great way to systematically put it to work and keep up the discipline of investing without chasing maybe share prices or where prices are at the moment. So incidentally, if you participate in your company's 401k plan, you're already doing this by default because you're putting money in every single paycheck instead of trying to time the market and invest all your money all at once. And then last, patience is indeed a virtue, even though I know that it's not always easy. But staying patient will continue to be a theme throughout 2023. Those are investor guidelines. Now, let's move on to economic themes for 2023. First of all, the global recession is something we're watching. Remember, the economic slowdown is happening across the world, not just here in the United States. But GDP is declining, and we will see low, slow, or no growth probably for the next few quarters. There's also a U.S. profit recession happening with corporate earnings and a housing slowdown, which means profits are declining. And we're seeing negatives from this point last year. I think the housing market will continue to slow the pace that we saw the second half of 2022. And then also disinflation simply means the rate of inflation is dropping, yet inflation still continues to be an issue. Consumer spending in the jobs market in 2022 made it harder to squash inflation, and the Fed will keep up the rate hikes until they achieve their target inflation rate. And also, I've mentioned in past videos that people are turning to credit to spend, and we expect drops in the credit worthiness and even maybe some delinquencies into 2023 for both consumers and companies. A potential silver lining of all of this may be that we'll see some relatively attractive valuations, but investors need to proceed with caution in jumping into stocks especially stocks that may be hyped up by the media. So I'm going to break down various investment categories on the next few slides. Let's take a look at last year's asset class returns. I know this is a busy and colorful chart, so if you need to pause your video player and take a minute to better understand this graphic, feel free to do so. But what you really need to focus on here are the colors, because each color represents a major asset class or a category in which you can invest your money if you want to build a diversified portfolio. So on the left-hand side is 2012, with each column representing another year up until 2022, which is on the right-hand side of your screen. And in 2022, we saw all major asset classes were negative, with the exception of commodities, which most people don't want to hold in large numbers in their retirement accounts, of course, and then cash. So commodities and cash were the only two categories that were positive last year. So that means virtually everyone lost money in 2022, even conservative investors who are exposed to the bond market. So let's look here at some of the different categories. The orange category does represent the bond market. That's the fixed income space. And you can see even the fixed income market was down pretty substantially last year. The best performing category of the last decade is that large cap growth box, which is kind of the navy blue box that you'll see there. But last year it was the worst performing investment category. So this just shows you that what goes up must eventually come down, and typically the best performing category of a prior year tends to be the worst performing category of an upcoming year. Now, I have 8 stocks represented here that are market giants, meaning these are stocks that are included in most mutual funds and individual portfolios, and they tend to be favorites amongst investors. So Apple, Amazon, Tesla, Google, Nike, Disney, Zoom, and General Motors. Take a guess which stocks started the year up and which stocks started the year down. The answer is they all started the year down, along with a lot of other company stocks, including every company on this page. Pandemic era darlings like Peloton and Zoom, they were down significantly, 78 and 63% respectively. Teladoc was down 74%. DocuSign was down 64%. Streaming services like Netflix and Spotify were down 42 and 66%, despite high usage and popularity. And companies like Tesla and Facebook were down 64 to 65% or so. You can see it's not just about new companies versus old companies either. Newer fintechs like Robinhood ended 2022 down, while traditional financial institutions like Citigroup also sunk in 2022. And even Amazon took a hit by 50%. Continuing on, you can see Silicon Valley favorites. Apple and Google are down. Car companies, consumer packaged goods, tech companies, and even grocery staples like Tyson Foods are down. So actually the stock market, which we measure typically by the S&P 500, was down 18.1% in 2022, while the NASDAQ finished down nearly 33%. And the reason I'm sharing this is to emphasize the importance of risk management and remind everybody that risk management strategies can help potentially minimize losses. Headlines so far in 2023 have pointed out recent stock market rallies, and some of these companies have bounced back a bit, but it will take time to fully recover losses from last year. In the tech sector, for example, I'm still not convinced that we've hit the bottom. Markets did rally in January, and so far again in February, with positive returns across all 3 major indices. So the S&P 500 rose 6.24% from January 1st through the market close on Friday, February 17th, whereas the Dow Jones Industrial Average rose 2.05%, and the NASDAQ Composite saw a 12.62% increase. This is, of course, good news, but there's more to the story. When you study previous bear markets like the dot-com bust of 2000, which is illustrated by the chart on the upper left side of your screen, using the S&P 500 index versus the great financial crisis of 2008, which is in the upper right chart on your screen, and then you compare it to present day in the bottom chart, you'll notice that we are still technically in a downtrend. It wouldn't be unreasonable for the current market to reverse course and test the 39.50 level perhaps. And if it holds there, that might be a sign that the worst is behind us, but it's still too early to tell. And we know that markets historically bottom before the actual economy does. So let's examine some economic factors worth considering. Overall, GDP has declined. Here you can see GDP from the second quarter of 2021 through the fourth quarter of 2022 with the yellow arrow. And we expect GDP to continue to decline and possibly hit zero growth this year. The Fed raised the interest rate by 0.25% at its February FOMC meeting. And while this is lower than some of the rate hikes that we saw last year, we now have a 4.58% Fed funds rate that is designed to kind of dampen inflation. And that's done by hopefully slowing down growth in the economy. So as of the date of this recording, today is February 19th, the national average on a new conventional 30-year loan is 6.77%. And the average rate nationally for a 30-year fixed refinance is 6.89%. Last year, we talked a lot about the Fed because the rate increases were one of the biggest factors slowing the economy and steering us toward a recession and also impacting the stock market. So while this is still important, we ultimately have a consumer-driven economy. And a lot of what happens this year will likely be determined by consumer-related factors. So things like consumer spending, the use of credit cards, employment, the personal savings rates of consumers, consumer confidence, and more. So let's take a look at how we started 2023 in those areas. On the housing front, what do each of these charts tell us? The pace of home sales at its lowest rate since 2010 is really what we've seen recently. And the housing market is pressured from multiple directions. On the left, we see that inventory is low as people are hanging on to their homes rather than putting them on the market. And rental vacancies are also low. And then on the right, we see that both single family and multifamily housing construction has grown ever since the crash in 2008, but single family housing is expected to taper off. And the number of new multifamily housing projects under construction may continue to grow in 2023, but this could potentially mean that people move from rentals to rentals rather than buying homes, which can help stimulate the economy. The manufacturing index is something that I also watch closely. So this represents new manufacturing orders, and this contracted for the fifth consecutive month in January, coming in at 42.5, which is about a 2.6% decrease over December. This metric is a monthly indicator of economic activity, and it's based on purchasing managers and their responses to surveys that they participate in. And it's really what you can see here is that this index is currently contracting, which is indicated by a reading of less than 50. So what does that mean when it contracts? Manufacturing activity from a purchasing standpoint is considered potentially a leading indicator. So a contraction means that these purchasing managers expect slower growth ahead. And new orders can be used to help anticipate future demand. And we are expecting weaker trends ahead based off of this data. But interestingly enough, the metric here typically hovers around the 45 mark in the past when markets have historically bottomed. And when we see this number bounce back to 50 in the future, that means we're back in expansion territory. Okay, so knowing that inflation is still the top concern on the minds of Americans, let's take a look at the latest news in this area. Each colored box in this heat map represents the relative level of inflation for a consumer price index component in a particular month. So green is good. That's what you want to see. And if you look over here on the right-hand side of the screen, we've got data out through the month of December. So when you see green, that means that inflation in these areas is easing. And this shows us a deeper view of inflation and which categories are facing higher inflation than others. So on the bottom right here, you can see a lot of orange and red, unfortunately. And these are the most recent months, like I said, of 2022. And these represent core services such as transportation, rent, education, medical services. And it's also important to note that energy and food, which are the top two rows here, and honestly, when you look at your budget, energy and food represent a huge portion of that. But those two categories are typically excluded from core inflation measurements that the Fed reports because they fluctuate so frequently. But energy and food are facing inflation too, and consumers definitely have noticed that in fuel and food prices over the last year. Pause your video if you'd like to take a closer look at this chart. Now, how is all of this affecting consumers? Consumer spending was at an all-time high in the third quarter of 2022, which seems like a positive indicator, but less so when you see what they were using in order to spend. So Prudential just recently conducted a study, and they asked the question, do you regularly run out of money and have to rely on credit cards or on family for financial support? And you can see here that over half of millennials said that they are strongly or they're somewhat concerned about running out of money each month, and they're having to turn to credit cards or family to cover the gaps. But 38% of all adults also answered yes to this question. So interestingly, in January, a University of Michigan Consumer Sentiment Index saw its highest bump since April of 2022. So this is going to be something to watch to see how confidence equates to behavioral patterns of consumers. This chart also highlights the rise in credit card use from 2002 on the left-hand side to a spike at the end of 2022 on the right. So credit card rates are up significantly. We're now seeing interest rates over 19%, which means that consumers that are turning to credit cards are going to be paying higher interest rates. So it's kind of like a double whammy when they have to pay higher interest rates, plus inflation is hitting them too. And they're turning to these credit cards because they can't keep up with the rising prices. So this could lead to a further dip in savings and also potentially credit delinquencies going forward. Now, this is the savings rate, personal savings rate for consumers, and it shows a big spike on the right from the pandemic when people had fewer places to spend money and they had received stimulus checks. And so a lot of money was sitting in checking and savings accounts and money market accounts. But you can see how sharply the savings rate has dropped since then. This goes back to basically the 1950s. And you can clearly see that we're sitting at pretty much an all-time low, even a little bit lower than the 2008 financial crisis. Also, Generation Z, so that is people that were born from 1997 to 2012. Generation Z is now expected to represent 30% of the workforce by 2030, basically. And a report by Fidelity found that over half of them stopped or suspended saving during the pandemic. And this is something economists are watching for, and they're factoring that into their longer term forecasting. And finally, the labor market. I've mentioned that the unemployment rate is a lagging indicator. It's typically one of the things we see. Companies don't lay off until things get bad. So although the economy added 4.5 million jobs in 2022 and another 500,000 jobs in January of this year, the unemployment rate is still not officially reflecting a recession. But it's something that we're watching closely because the labor market is losing steam. And the unemployment rate is an aggregate, so it looks at all different sectors. But when you look at specific sectors, there's another story here as well. So this represents tech companies that had layoffs across the board in 2022 and so far this year. And we saw a big spike in the month of January 2023. These layoffs are taking place at previously high growth companies, so companies like Salesforce and Google, Microsoft, and Amazon. And I've given you a lot of information here, so it's time for probably a deep breath. I know I just put a lot on the table, and the reason that I'm doing this is because I believe that knowledge is power. And there are so many sources of market news, and I want to provide you with as much direct and clear information as possible, even if it's not all rosy, unfortunately. But but I want you to be able to make informed decisions about your money and your future. There are many other factors, of course, affecting the economy that will potentially affect your investments and markets this year. And everything you see on this page can give us signs and clues about what may be to come. So we're watching the yield curve. It is steepening. That's not necessarily a great sign. We're watching international stock markets. They're still struggling even more than the United States. We don't have a lot of time to go into that in much detail today, but we will keep an eye on all of these indicators and more and make sure you're always informed. Now, a few bright spots, even with slow growth, the second half of 2023, I believe, should have more positive news than the first half. China's reopening could boost their economy faster than originally expected, which could help the global economy overall, even with Europe still experiencing stagflation. With tech hopefully bottoming out at some point, there could be some good buys later this year. But of course, you should speak with an advisor about your specific situation to determine what is right for you. At EverThrive, we aim to always provide proactive communication and help our clients through any economy or market condition. So back to the earlier question, should I de-risk or should I just stay the course? If you have a long-term time horizon and you have a high tolerance for taking risk, I believe you're okay to stay the course right now. But if you have a shorter term time horizon, or maybe you're more risk averse and you're concerned about your money, it may be a good time to consider further de-risking. Cash is finally paying a nice rate of return, but it's important to remember that the rate of return cash is paying, as good as it is right now, is still not as high as inflation. So holding lots of cash means you're still losing purchasing power. But if it's cash you want, I'm happy to help point you in the right direction. And either way, we are here to help you and answer any questions that you have. Thank you again for joining me, and I will see you next month.